Well, I appreciate it, and thank all of you for taking time out to see this particular presentation. These are unusual times, to say the least. I won't use the unprecedented term. Well, I guess I just did because it seems to be overused, but clearly this is something unusual. We're not used to this stay-at-home, this quarantine. It's frightening, right? These definitely are uncharted waters. And what I want to do today is talk about how we navigate this stock market volatility, right? All of this, we get the market going down, we get the market going up, and, it's confusing to many of us. It can be scary, and hopefully we'll put some of those fears to rest. We definitely are now in a coronavirus world, and again, while pandemics have occurred from time to time throughout history, this one seems to have struck a chord because it happened, it's happening now, and it's affecting so many people around the globe. So we get it, right? We understand that the markets have gone down here recently, but if you take a look at a little bit broader picture and you look at the last 10 years, they've actually performed exceptionally well from the financial crisis, right, moving forward. So from March 31st of 2010 through March 31st of 2020, even with the big market decline that we've experienced here, we still have averaged 10.5% per year for the last 10 years. So investors that began investing 8, 9, 7, 5 years ago, right, they have been rewarded with their patience when the market has gone down. We've had little dips along the way, but again, they've been rewarded. They get it. They understand. People, however, that have invested recently don't have that experience, especially to see a market drop like we've seen. Now, the good news is we've recovered quite a bit of that, but it's still unnerving for many to see that market decline. There's 3 things I want to cover today. The first is to put the current shocks in historical perspective, talk about what's going on in our heads, and then how we live with market volatility. But I think it is important that we put the current shocks in a historical perspective, right? The market has bull periods, right, when things go up, and then the market has periods when things go down, or bear markets, right? It's inevitable as an investor that they happen. And if we go back and look at the data till going back to 1970, we can see that there have been quite a few of these bear markets and fairly significant shocks along the way. I say fairly significantly because this one seems a whole lot bigger than the 34% drop we've had, right? Now, we've recovered a lot of that, but we had gone down 34%. To put that in perspective, the financial crisis caused the markets to tumble by 55%. In the 2001-2002 period, the markets were off 47. 1987, very similar term in terms of the downturn, down 30%. And back in 1973 and 1974, the markets were down 43%. So we've been through a lot worse than we've just gone through. This one just feels so much bigger because of the speed and the veracity of the downturn, right? But if we look at the speed and veracity of the upturns following these bear markets, it's pretty remarkable. The worst recovery so far, long-term recovery, has been 53% following 1973 and 1974. We've had them as large as 845% recoveries over 13 years from 1974 to 1987. And for those of you who are looking at the graph, you'll see that we do include the end of March when in a week, 1 week period of time, the market had recovered 16%, the best single week performance in the market since 1930. So my point is this. After every bear market, we've had a bull market, right? And every one of those bull markets has gone to all-time highs. Bull markets last longer, on average, 7 years and 4 months. The average growth, 396.9%. Bear markets, good news, don't last that long. The average is 13 months, and the average fall is 42%. Now, we don't know exactly where this will end up, but if the current lows in the market hold, this will be reportedly the shortest bear market on record. We'll see. But we do know that market declines are part of investing, right? Oftentimes we get market pullbacks and corrections. Well, how often? Going back to 1970 through March of 2020 of this year, right? We get a 5% or more decline about every 10 months. The last one was back in August of 2019. We get a correction of 10% or more every 2 years-ish on average. And the last was December of 2018, 15% or more every 4 years, and 20% or more every 8 years. So they do happen. The good news is bull markets tend to run longer and have a larger recovery than we went down in the bear. But we've also experienced pandemics and epidemics before, right? If we go back to 2000, here they are. Here's SARS, right? Here's swine flu, Ebola, Zika, and now COVID. Obviously, COVID's had the biggest impact on the market because while it's not as deadly as Ebola and SARS from a morbidity ratio, it has, however, caused us to voluntarily shut down the world's economy. And that's the big impact of COVID, right? We're all staying home so that we can make sure that we don't infect other people. This is not a financial crisis that has morphed into a health crisis. This is a health crisis that has morphed into a financial issue because we are staying home. And we're already, as I mentioned, hearing about reopening the economies. I know Spain has announced that some workers are going back to work. Germany as well is actually starting schools again. If we look at those epidemics in the past, here they are. Here's SARS, swine flu, Ebola, Zika, and COVID. And we show the local markets that were impacted. For example, back in 2003, the Hong Kong market was affected fairly substantially by SARS. It went down 9.3%, and you can see the other data points here. 1 month later, those markets had recovered. And then 3 months later, they had recovered significantly. Obviously, with COVID-19 shutting down the world's economy, it might take longer than 3 months to get back. We don't know. That's the great unknown. But I'm very comfortable in saying that over time, we will recover and recover nicely from this. And it's already seemingly happening if we look at the financial markets, right? But what we need to do is make sure that we control our own emotions. I cannot stress this enough. In fact, the takeaway from the presentation today is this. Learn to control your emotions and take advantage of other people who cannot or will not control theirs, and you will do very well. The same fear, right, that caused people to panic, knowing they had plenty of toilet paper, but were outside of Costco watching people come out with pallets of toilet paper who suddenly said, oh, maybe I better outrun that guy or that woman in Costco because I think I can. I'm going to get more, even though they didn't need it. That same mentality caused them to sell stocks a little over a month ago and to still panic today when they see that the market might be down, right? Well, rational thought is in our frontal lobe. That's where our creator put it, right? And the frontal lobe is very, very important to us. Again, that's where rational thought occurs. But deep in the brain is something called the amygdala. And in the amygdala is where we assign emotions to different stimulus, right? Our creator put it there for a reason. If we were to hear the roar of a saber-toothed tiger, we'd know whether we needed to stay or flee, right? But in the world of finance, because oftentimes we've associated fear with that stimulus, we don't see the opportunities that present themselves. Nowhere else do you see things going on sale and you get afraid, right? But in the financial markets, you do. And it's because of the amygdala and that emotion that's been assigned to it. So what we need to be careful of is another bias that our creator has cursed us with called loss aversion, right? And that's where the pain we associate with a loss is much more intense than the reward felt from a gain, right? We want to flee. We want to go to cash. And that certainly happened in the dot-com bust back in 2000, right? $491 billion came out of the market and went to cash. In the global financial crisis, $943 billion came out and went to cash. And cash is great for the short term, right, for your immediate needs. It's just not going to get you, in my opinion, where you need to be in terms of your long-term goals. They have not changed. The financial situation currently has changed for the near term. Your long-term goals have not. And cash, adjusted for inflation, just isn't paying enough to get you where you need to be. So what do we need to do? We need to live with the market volatility and understand how to do that. The first thing we need to do is stay calm, right? Very easy to say, very difficult to put into practice when you see the volatility, right? We want to be nervous about it, right? It's our nest egg. But if we keep a long-term perspective, it helps. Again, this is a health crisis that has morphed into a financial issue. We've had a number of crises going back to 1970, right? Energy crises. We had Black Monday, the tech bubble burst, as I mentioned earlier. We had the global financial crisis. Now we've got COVID. But even with all that, for the last 50 years, the market has averaged a little bit over 10% for the 50-year period ended March 31st, 2020, using the S&P 500 as that benchmark. Pretty amazing. What we really need to do to stay calm is to tune out the noise. What this particular chart shows is a 50-year period-ish from December 31st of 1970 through March 31st of 2020, right? And if you take a look at it, over one-year periods, 80% of the time the S&P 500 has been positive. Over 5-year periods, 90% of the time it's been positive. And over 10-year periods, 91% of the time. I like those odds. I know that we're going to be just fine over time if I look at those particular odds. The other thing that's important is that we build diversified portfolios, right? They can help us through these bumpy markets. We also need to remember our long-term strategy. It might be tempting to pull out now, but we need to stick with our strategy. And I hope that this chart actually drives that point home, because what it shows is inter-year corrections, right? Those are the blue bars. That's sometime during the year the market was down that particular amount, and then the green represents where the market closed that year using the S&P 500 as the index, right? For example, in 1998, at one time, the market was down 19%, yet we finished up 29%. So we get these kind of corrections and these kind of pullbacks fairly frequently. What we need to do is trust our financial advisors, right? Stay with it. I often get the question, well, is now the time I should be putting money in? I actually had the opportunity to ask that to Sir John Templeton, the legendary investor, the founder of Templeton, the part of Franklin Templeton, right? I said, hey, Sir John, what's the best time to invest? And he somewhat chuckled, and he said, when you have the money. And I know what he meant by that. Don't borrow money to be investing, right? That's his long-term strategy. But he would also go on, I'm sure, to say that dollar cost averaging is the best way to invest as well. There's no way to pick market bottoms and market tops, in my opinion. I've worked with the best of the best over my decades of experience. Nobody can do it consistently, and the best way to get around that is to dollar cost average, to invest on a regular basis. And then finally, we also know that you need to stay in the market, right? It's time in the market, not timing the market, that makes the difference. Had you stayed fully invested for the last 20 years that ended March 31st of 2020, you would have averaged 4.85% on your money, right? Had you missed the 10 best days, it drops considerably. The best 20, you're now compounding at a negative rate. And so we know we need to be there. Well, when are those best and worst trading days? Interestingly enough, usually right next to each other. The best trading days often occur one day after the worst. We just saw it a month and change ago on that Monday when the S&P was down, the Dow was down 12.94%. The next day was the largest single point day in market history. It's not included in this particular chart because that happened after March 31st. But you can see that it has happened historically. So we've covered a lot. A couple of key takeaways. First is that history has shown us that while markets react to shocks in the short term, they do reward patient investors over long periods of time. Emotions affect decision-making ability in times of market volatility, no question. And we covered 3 strategies to live with market volatility. Stay calm, make sure you're diversified, and remember your strategy, right? Your long-term goals have not changed. The financial situation has. Now, I don't know if your financial advisor looks like this in a pair of shorts. Typically, you see them in a suit. I get it. But regardless, your financial advisor can help build a long-term strategy, keep your emotions in check, and stay on track. I mentioned a take-home from the presentation earlier. There's one more, right? It's a checklist for you, and that's to call your financial advisor and make a virtual appointment today. It's important that you stay calm in this and seek out opportunities that might be presenting themselves. we appreciate it. And Jennifer, I'll toss it back to you.
Thank you so much, Dan, for today's presentation. And it is very important to stay calm during these unprecedented times. And like Dan said, your advisor today probably doesn't look the same. And all you do have to do is go to our website, and there is an appointment link. So thank you very much, Dan. Thank you for this presentation. And if
Thank
you
you.
have questions, definitely set that appointment. Thank you, and have a great day.